everyone. Today we will talk about the portfolio management strategy, the chapter 7. In this chapter, we will introduce the passive investment strategy first to help you to understand what's the passive portfolio management, how can we construct the passive portfolio, and then we introduce the tracking error and methods of index portfolio investing. The next part we will introduce what's the active investment strategy. How can we do the active investment? 7.3 is asset allocation to help you to understand how can we make asset allocation between different asset class and doing some adjustment between them. And the last part, we will introduce how the mutual fund manager use the strategy, like pure alpha strategy, smart beta strategy, etc. So that's the whole chapter. Now let's have a look at the 7.1, the passive investment strategy first. Okay, what's the passive portfolio management? The passive portfolio management is replicate the performance of index. So it is mimic a market index. In the long term, it can be a buy and hold strategy. The passive portfolio management usually track an index over time, occasionally rebalancing at the composition of the underlying benchmark. Change and cash distribution must be reinvested. So generally speaking, the passive portfolio management, they didn't rebalance frequently. When the benchmark changed the weight, the passive portfolio will definitely change their weight, the composite. And the last point is the manager is judged on how well they track the target index, minimize the deviation between portfolio and index return. So in the passive portfolio, they didn't ask you to obtain absolute return. They ask you how they construct that portfolio can track the target index. So in other words, it will minimize the tracking error. Now let's introduce the index portfolio construction techniques. We have 3 different techniques for index portfolio construction. One is full replication, the other is sampling, the last is quadratic construction. And let's have a look, the first one, the full replication. The full replication is all security in the index are purchased in proportion to weights in the index. So it's quite simple. You fully replicate the market index. I can give you an example. If you fully replicate the SSE 50, you will definitely hold these 50 stocks in your portfolio. So that's the fully replication. And this will help you to ensure close tracking to the to your benchmark index. And the last point for full replication is increase the transaction cost, particularly with dividend reinvestment. This case will happen if you hold the full replication portfolio, if you hold many stocks in your portfolios. All this stock, they pay the small dividend at different time in the year. Definitely, it will cost you lots of transaction cost. The second technique is sampling. Sampling means you buy a representative sample of stocks in the benchmark index according to their weights in the index. In this method, you don't need to hold a large number of stocks in your portfolio. You only need to choose some of the stocks in your portfolio. So for example, if you are tracking the CSI 300, in sampling, you don't need to include all these 300 stocks in your portfolio. You can only choose 30, 50, or 100. It will depend on your strategy. So the advantage of sampling is you can avoid a large number of stocks in your portfolio. And the second point is fewer stocks means lower transaction commission. So that's the opposite to the full replication. And reinvestment of dividend is less difficult because you hold less stocks in your portfolio. And finally, for sampling will not track the index as closely, so there will be some tracking error because it is not fully replication, and there will be some difference between your portfolio and the benchmark portfolio. Now let's have a look at the third techniques. That is the quadratic optimization. We can also call it programming techniques. For the quadratic optimization, historical information on price change and correlation between securities are input into the computer program that determine the composition of the portfolio that will minimize tracking error with the benchmark. So in your portfolio, how can you decide the weight? It will depend on the historical information about your individual assets. So we need the correlation, historical correlation, and also the expected return and variance for each individual stock in your portfolio, and then we can put them into the computer using Excel solver or using MATLAB to calculate what's the minimized tracking error for this benchmark, and then we can find the weight for each individual stocks. So that's the quadratic optimization. So this rely on the historical correlation, which may change over time. So that might be the disadvantage for this method because you are rely on historical information. So if historical information can not keep the same in the future, definitely it will affect our portfolio construction. So this will lead to a failure to track the index. So that's the three different techniques to construct our index portfolio. Now let's have a look. As I mentioned before, the aim of the passive portfolio construction is to minimize the tracking error. So the goal of the passive manager, they should be to minimize the tracking error. So in this slide, we will introduce you how to do the tracking error. For the tracking error, before the tracking error, we need to talk about the active return. The active return is the difference in return between a managed portfolio and its benchmark. So in this equation, the delta T should equal to RPT minus RBT. That's the portfolio return minus your benchmark return. So that's your active return. And we mentioned that later in the next chapter, we will separate this active return to asset allocation return and security selection return to have a look what's the contribution from the managers. Is it from market timing or from the security selection? And the next point is the active risk. So the active risk is the standard deviation of active return. We also call the active risk is tracking error. So in the passive management portfolio, all the portfolio managers will minimize the tracking error in their portfolio. So how can we calculate this tracking error, this active risk? It should equal to the standard deviation. So here we use the standard deviation of this active return. And if you calculate by yourself, it could calculate based on delta T, which is your active return at time T, minus the average of delta, minus the average of active return. And then you square them and sum them together and divide by n minus 1 and square root. So that's the active risk equation. Now let's have a look at an example to show you how can we calculate the tracking error using Excel. So now I give you the portfolio return and benchmark return here, both for 12 months. So this is the time series data. I gave you each month's return. First, we need to calculate the average return. So in Excel, you can only use the average function to calculate this average return for portfolio or for your benchmark. And then you need to calculate what's the difference between your portfolio and benchmark. So you can use this one minus this one, and you can calculate this RP minus RB. And if you calculate all this RP minus RB, you can calculate the average of your active return. So that's your delta bar. So you can use the function in Excel, standard deviation function, directly calculate the standard deviation here. That's the standard deviation of these numbers. So you type equal STDEV and select all the data here. You can get this number here, the standard deviation. And if you don't have Excel, you can base on the previous equation to calculate the standard deviation by your hand. And the next one, let's have a look. This is the information ratio. The information ratio we can write down as IR. We will talk about more about information ratio in the next chapter, the chapter for portfolio performance evaluation. So you can learn more in chapter 8. And this IR should equal to your average active return over the active risk. It's equal to this 0.0017 over 0.0063. So that's your information ratio. Now in this case, we show you how to calculate the tracking error. What's the active return, what's the active risk, and information ratio. Now let's have a look at this tracking error range. From the previous empirical study, we find that most passive portfolio, their tracking error is less than 1%. Sometimes it's less than 0.5% or lower than this normal rate. And for the active portfolio, the tracking error is over to 3%. Sometimes it is 5% to 15%. Between this passive and active portfolio, we called it is structured portfolio. So the tracking error between these two is the structured portfolio's tracking error range. And the next point is the tracking error in passive portfolio investment. You can think about the tracking error in passive portfolio, and we mentioned that all the managers, they want to minimize the tracking error. However, there is a opposite direction between you using the full replication and sample. So I will give you an example. If you are doing full replication, such as you are mimic the SP500, and you include 500 stocks in your portfolio. In this case, the tracking error is small because you include all the stocks in your portfolio. However, the balance cost is large because there are large number of stocks in your portfolio, and all these stocks, if they doing some distribution, and you need to reinvest all this money, so the rebalancing cost is large, and sometimes if the weight for this 500 stocks change, you need to rebalance again. And for sampling, in this SP500, if you are doing sampling, you might choose might be 100 stocks from these 500 stocks. Based on your strategy, I will show you if you are based on market capitalization, you choose the largest market capitalization stocks, 100 in your portfolio. If you're using this smaller sample, it is easy to management and it is less time consuming for you and lower trading commission. But the tracking error is large because you want to mimic this 500 stock, but you only choose 100 stock in your portfolio. So the tracking error is large. So generally speaking, based on minimized tracking error to construct your passive portfolio, definitely it is art. You need to balance the benefit and the cost for the tracking error, doing full replication or the sampling.